In this module, we'll be covering Chapter 2, Financial Markets and Interest Rates. So the learning objectives here are to have an understanding of the financial system, how financial securities fit into that, how those securities are traded among financial intermediaries, how financial markets work, and how certain types of securities are traded in the money market or the capital market. So the reason we have a financial system is that we have different entities, we could call them economic units, that generate and spend funds, and we need to get the funds from where they're available to where they're needed. So we have surplus economic units who are businesses or individuals or government entities that have funds left over after they've spent what they want to spend. And we have deficit economic units that need to acquire additional funds in order to spend at the level they wish to spend. There's not anything automatically good about a surplus economic unit, and there's not anything automatically bad about a deficit economic unit. We're simply talking about the need for funds in one place and the availability of funds in another. So, able to make this flow of funds happen, we have to provide a mechanism whereby those funds are traded or exchanged for securities. A security is a piece of paper, a document that represents the right to receive funds in the future. It could be a bond that entitles you to collect interest and principal payments in the future. It might be a share of stock that entitles you to dividends potentially in the future. And we have financial intermediaries, banks, insurance companies, credit unions, and so on that sometimes facilitate this process, and those will be covered in Chapter 3 in greater detail. So we have to get some terminology down here. The primary market is where deficit economic units sell new securities to raise needed funds. So this might involve a corporation going to Wall Street and hiring an investment banking firm, which facilitates the company issuing a new bond, issuing new stock in order to raise the funds that they need. That would be an example of a primary market. So in a primary market, we have the investor who provides the funds and receives the security in return. Note we're going to have a lot of diagrams here with arrows moving in both directions because by definition a market transaction requires agreement between the two parties, the party offering the funds and the party offering the securities. The secondary market's probably what you're better familiar with. When you log on to your online brokerage firm and buy 100 shares of AT&T, that transaction is taking place on the secondary market. So when you buy those shares of AT&T, you're buying them from another investor like you who happens to own AT&T. So the secondary market makes it possible for the two of you to get what you want. You get your AT&T and the other party gets the amount of funds that they require before selling that AT&T stock. A little bit more jargon, money market, capital market. The money market is the name we give for the place where short-term securities are traded, treasury bills, commercial paper, negotiable certificates of deposit, and some others. This is mainly done in the big financial centers, Tokyo, London, and New York. The capital market is the term we use for the place where long-term securities are traded. Bonds, stocks, Stocks, of course, have an infinite maturity, so I would certainly consider that to be long term. These can be on the New York Stock Exchange, the American Stock Exchange, the NASDAQ over-the-counter market, and a host of others. So sometimes financial institutions act as intermediaries to help facilitate this. So here you can see we have two sets of arrows moving in each direction. On the right-hand side of the diagram, you can see the funds going into the financial intermediary, into the financial institution, and the investors receive securities called checking accounts, savings accounts, life insurance policies, etc. On the left-hand side of the diagram, you see the securities being issued by the business. It could be issued by a government entity or an individual, and the funds being provided by the financial intermediary to that entity. We hope that this process is efficient, so if it is easy to do, it happens quickly, and if the costs are modest, then we refer to that market as being efficient. And so securities issued by large companies are generally efficient. If you want to look at the other extreme, the real estate market is not a very efficient market. It takes you months typically to sell your house, and you have to pay a big fat commission in order to do it. So the more efficient the market is, the easier it is to get those funds that are lying idle to get to the parties who need those funds, and this is going to cause greater economic activity, gross domestic product, GDP, if you will, which helps create jobs and makes life easier for all of us. If the funds are to just sort of lie there idle, we're going to have lower growth, higher unemployment, and very few people want to see that. And having an efficient market makes it easier for you to change your mind. So you can sell the stock you previously bought when your perceptions change or your preferences change, and you can do that at a low cost, and that's a good thing. So again, some of what we're covering in this chapter is descriptive. The money market is a place where we have treasury bills, CDs, commercial paper, euro dollars, bankers' acceptances. So treasury bills are issued by the federal government itself, the Department of the Treasury. After they are sold, they are actively traded in the secondary market, mainly through what are called primary government security dealers, which are a handful of very large commercial banks that buy and sell many millions, hundreds of millions of dollars worth of treasury bills in a single transaction. Treasury bills are bought by the investor at a discount to face value. That is, if the face value were 100 and you bought the treasury bill at 98, then at maturity you would get the full $100. Negotiable CDs are not the kind of CDs that you and I would typically put our money into. These are what big institutions buy. They have maturities of a year or less, and they can be traded also in the secondary market. Commercial paper is an unsecured debt obligation, and only corporations with excellent credit ratings are able to successfully issue commercial paper in the primary market. And euro dollars are dollar-denominated deposits located in non-U.S. banks. So just to make up a hypothetical, if there's such a thing as the First National Bank of London, some of the deposits at the First National Bank of London might be denominated in U.S. dollars. Bankers' acceptances are drafts or promises to pay that have been accepted by a large bank. And when we say accepted, we mean that they've been guaranteed by the bank. Capital market, we have the bond market, which is the market where a company or a government entity will sell a piece of paper, which is an IOU, a promise to pay. It has a face value, which is the amount paid at maturity. It has that maturity date, and it has a coupon rate. And so if you had a $1,000 face value bond with a 4% coupon rate, then the investor would receive $40 per year until maturity, and then at the maturity date, along with the final $40 interest payment, there would be the $1,000 principal payment. Bonds are issued by the U.S. government, so-called treasury bonds. They're issued by municipalities, cities, states, other government entities such as school districts. Some of them are general obligation bonds, which means that the bond is a claim on all the resources of the issuing entity. Other municipal bonds are revenue bonds, which are backed only by the revenues produced by a specific revenue generating entity, such as a toll road. So you could buy a bond that was issued to finance a toll road, and only the tolls would be available to you to satisfy your claim on interest and principal. And corporate bond is pretty self-explanatory. So another type of security that is available in the capital market is stock. And so common stockholders, as was discussed in chapter 1, are the owners of the firm, and they get to vote on major decisions, and they also get to vote on the people who serve on the board of directors. There is the possibility to receive a dividend if the company chooses and is able to pay such a dividend, and there's also the potential for capital gains if you can sell that stock to another investor at a higher price. There's another type of stock that's called preferred stock. Usually preferred stockholders do not have voting rights. The word preferred stock comes from the fact that the investors in these securities have a preferred position relative to the common stockholders to be paid. That is, when we talk about the priority of claims, the preferred stockholders are in front of the common stockholders when all the claimants line up in order to get what is owed to them. So what is owed to a preferred stockholder is a preferred dividend. Now we've got interest rates that are determined by the market on the different types of bonds that are out there. And so those determinants are the real rate of interest, inflation, default risk, maturity, and illiquidity risk. So we're going to look at those individually. The real rate of interest is the amount of interest that is offered by the one party to the other for the lender's lost opportunity to consume. So if I were to borrow money from you for a year, say $100, I have $100 more spending power for the next year, and you have $100 less spending power in the coming year. And so there's going to be a certain amount of interest that is going to be demanded by the lender who is losing the opportunity to spend that money, and will be willing to be paid by the borrower who has an increase in the opportunity to spend more money. We have default risk, and this recognizes the fact that frequently an issuer is at some risk of not being able to pay back the money. This may not happen often, but the risk is there. And so the borrower and the lender both recognize this particular risk. And so the greater the chance of default, the greater the interest rate the investor will demand, and the greater the interest rate that the issuer is going to be forced to pay. Remember, both parties have to agree to the interest. We have expected inflation. I want to emphasize the word expected. It doesn't matter what inflation was last year. What matters is if you and I are going to enter into a debtor-creditor relationship for the upcoming year, we're both worried about what's going to happen to inflation during that upcoming year, not the past. So inflation erodes the purchasing power of money. And so if you loan somebody $1,000, then if there is inflation during the upcoming year, the $1,000 that's paid back a year from now will have less purchasing power than the $1,000 that was offered up today. So you see an example there with a 5% interest rate. We could talk about maturity, and I'm going to talk about this a little bit more in a different forum when I walk you through a yield curve using something from the web. So I'm going to give that a pass right now and talk a little bit about illiquidity risk. If the entity which is issuing the bond is not very well known, and if the investor would have a difficult time selling that bond without losing value, that would be problematic for the investor. And so the issuer is going to be forced to pay a higher interest rate, and the issuer is going to be forced to pay a higher interest rate, and the investor is going to demand a higher interest rate to compensate the investor, the lender, for the inconvenience of being stuck in a bond that is very difficult to sell. So we can add all those things together, and we can see that the market rate of return, the nominal rate of return, is the sum of all these factors which combine into a market equilibrium interest rate. So that's what we're going to do here. And when we get to term structure of interest rates, you're going to see how we can explain why a particular relationship exists between maturities and market interest rates. And so what emerges is the yield curve. Here you can see what the yield curve looked like on August 3rd, 2012. So this shows you interest rates on a bunch of different bonds. These are treasury securities that differ only in maturity. We tend to use treasuries because of the fact that those other factors are pretty much equal. That is, all other things remaining equal. Here's how interest rates vary according to the maturity of different treasury securities. So I'm going to call it quits right there, and I'm going to have another presentation that's going to go into some deeper discussion of yield curves.